Today we're going to talk about some specialty tax areas. Primarily we're going to focus on personal service business, or what is commonly known as PSBs, and HST, specifically on related to real estate. We have Danny DePasquale here. Danny was a manager at KPMG. He is currently working with us at INA in the tax area. He's a tax expert, and his background is ideally suited to talk about these areas. So Danny, if you could fill us in on some of the areas, I'd greatly appreciate it.
Thanks,
Thank you.
I guess the main question you should ask yourself if you're running your own company is, do you have no employees working for you, and are you billing only one customer? If you answered yes to any of those questions, you should stop, and here's why. Being declared a personal service business can really cost you. Canadian consultants and contractors need to take extra precaution.
Danny, can you provide us some insight on what a PSB really is?
Absolutely. A PSB is essentially a business that is carried on as a corporation, whereby the services performed by that business are provided by an individual who would reasonably be considered an employee. The classic example of a PSB is the employee who terminates their employment contract with their company and incorporates his or her own company and provides the same services to their former employer. The new PSB rules have been introduced for corporate tax years beginning after October 31st, 2011, primarily due to the major disparity between the corporate and personal tax rates. Therefore, CRA wants us to stop the use of the corporations as a tool to minimizing taxes. The new rules which were introduced are very punitive. If an incorporated employee is caught under these rules, the following punitive measures would be taken by the CRA. First off, the corporation would be denied the small business deduction of 15.5%. The shares will not qualify for the $750,000 capital gains exemption. The corporation would also be denied any expenses except any salary paid and any general deduction an employee would otherwise be allowed to take. The new rules are effectively imposing a burden on the taxpayer if those choose to structure their compensation in this manner. The burden arises from the overall PSB tax rate of approximately an alarming 58%, which far exceeds the top marginal tax rate in Ontario for employees, which is roughly 46.4%.
So basically, Dan, we're talking about a difference in taxes of 15% to 58%, 43% difference in tax. So what we should talk about now is, how do we avoid being deemed to be a PSB, especially when I'm legitimately leaving my employer and setting up my own corporation, but my ex-employer still becomes my major contract?
That's a very good question, Nick. There are a few ways to not be considered PSB from a CRA perspective. The first one is the corporation would need to employ more than 5 full-time employees, and the taxpayer can also argue via the CRA tests, and we'll briefly discuss and touch on them here. The CRA would use the following tests when determining PSB status. One is control. The CRA would look at who controls the individual.
In other words, who's telling them what to do at that point in time?
Exactly. Our second test the CRA would use is ownership. Who owns the tools necessary to perform the work?
Such as tools such as trucks, computers, backhoe, if you're working in contracting.
Exactly.
And other things like that.
Exactly. The next one is profit. Who possesses the chance at profit or the risk of loss?
So in other words, if you're getting paid just a straight salary, right, you really have no risk.
Exactly.
But if you're getting paid on a contract by contract job, on job by job basis, then you have determined you're taking on that risk.
Exactly.
Okay.
And the final test the CRA uses is integration. How many clients do you have? Obviously, more clients you have, the better argument can be made.
That makes a lot of sense.
Again, it's important to be able to prove to the CRA that you are not in an employee-employer relationship.
And how do we do that?
Main things that you should outline and use before you do decide to incorporate is, one, of the service contract. Outline the independence, external, office, etc., things like that.
Tools, maybe?
Tools, it's another good one. Another one is providing services to more than one entity. Obviously, again, it's going to provide a stronger argument if you're billing one person versus 15.
Right.
3, having other employees, not necessarily 5, but having employees on payroll and paying a team, again, with the argument.
So if I left with 3 of my buddies and I set up a company with 3 of them, I'm less likely to have a chance being deemed to be a PSB rather than if I go by myself.
That would definitely help the argument. 4, having another individual that provides other services totally unrelated in the company. Providing your own tools is another method of avoiding the risk.
So if I have my wife who's doing consulting on one side and I'm doing consulting on the other side, and we pool our resources, that would be helpful because we're doing different things in one corporation.
Exactly. Finally, ownership of the company in another individual's name, not preferably a non-related person.
There's a trap here, and we're trying to give ways to get around that trap. If we're considering incorporating, you can contact us to go over this. I think what you've got to do is these things, the rules are complicated. Make sure you go to a professional to set up the corporation if you're going to be doing this. I think that's what we have to tell all our clients or potential clients, that you should seek professional advice because it is very dangerous. And as we noted, the difference is a 43% tax difference between being a PSB and being what we call a Canadian controlled private corporation or a small business.
Absolutely.
If you're already incorporated and operating a service company and think you may fall into these traps, it's imperative that we go back and set up all the things. Even though they may have not done it up to this point, we should go back and do it now, at any time. And especially, you should be talking to your quote-unquote employer or the company you're working for to remodel all your contracts.
Absolutely.
At this time. Okay, so let's move on, and we've talked about PSBs. I think we've covered that. The next thing I'd like to talk about is, let's talk about the HST.
I guess the first point we can touch on is HST and rental income. For residential tenancies, HST will not apply on rents. However, for commercial tenancies such as industrial, office, and retail, HST will be charged on rents. However, most commercial tenants will qualify to recover the HST paid through the input tax credits, assuming they are an HST registrant themselves.
What happens if I have half commercial, half residential?
Usually in that instance, Nick, the rents will be prorated to reflect the commercial portion.
Okay.
HST would be applied.
Okay, so let's talk about HST on condominiums.
Sure. For residential condominiums, HST will not apply on monthly common expenses. However, as is the case with commercial rents, HST is payable for commercial, retail, office, industrial, condo, common expenses. Most commercial condo owners, again, qualify to recover the HST through the input tax credit.
For example, I think for property taxes, there's no HST if you pay it directly, but if it's part of TMI, you would be paying HST on top of that.
Correct.
Okay. How about if I sell my cottage or vacation property?
Okay, that's another good question. HST will not be payable on the price if the property sold by the seller and bought by the buyer is for personal use property.
Okay.
However, if the seller had been renting out the property for more than 50% of the time during ownership, the price will likely be subject to HST. If the property being sold was part of a rental pool, HST will apply in this case.
So if I use it for commercial purposes, then I have to charge HST when I sell it.
Correct.
That makes sense. Okay, so how about I sell my own residential property?
HST will not apply in that case.
Right.
With a personal use property.
How about if I'm a builder and I sell a brand new residential property?
If a residence is being purchased and has been substantially renovated, it will be treated in the same manner as buying a new construction home from the builder, and HST will generally apply on the sale price. However, the Canada Revenue Agent states that a substantial renovation refers to a renovation where at least 90% of the interior of a building has been removed or replaced. So
if I take it down basically to a fireplace, that would
consider 90%, and HST would apply.
And that would be the same as a builder. Okay, Dan, why don't we talk about vacant land?
Sure. Most instances when you hear vacant land, it can be maybe farmland.
Yep.
In this case, HST will typically apply to the price of such land if the farmland is sold alone. However, if the land is sold as part of a farming business, it can be treated differently.
Those farmers get all the breaks.
Absolutely. In terms of vacant land as a building lot,
Yeah.
HST will typically apply to the price when the seller is involved in a commercial real estate activity. However, some of the lot sale prices might be exempt from HST if the seller is not engaged in a real estate commercial activity. And again, with vacant land, there's the personal use of vacant land. If you've been holding on to it for a while for personal use, no HST is payable. And if an individual sells personal use vacant land, which would have been exempt from GST.
So if I'm planting tomatoes on that land, I would be exempt from GST
Yeah,
or HST. I think the big one is builders and how builders deal with HST when they're selling their homes.
A good point is I'll talk about how the buyer
Right.
the HST on the sale price as well. So HST in new housing, builders who sell new or substantially renovated housing should also be aware of the new housing rebate, also
Yep.
known as the NHR. The NHR can be assigned to a builder from the home purchaser on closing.
Yeah, and typically is because the builder builds the HST into his price.
Okay. So the NHR allows purchaser to recover some of the federal 5% portion of the HST.
Right.
So for homes with a base price, just to give you a rough estimate, the NHR is calculated as follows. So for homes less than 350,000, 36% of the HST can be recovered.
Right.
For homes from 350 to 450,000, the percentage declines on a sliding scale. And if the house is greater than 450,000, or the portion greater than 450,000, the rebate is totally unavailable on.
In other words, in Toronto, there are no rebates.
Exactly. There's also a pretty good HST credit with respect to new housing rentals.
Okay.
So builders who sell new or substantially renovated housing should also be aware of the new residential rental property rebate, the NRRP. This is an HST rebate available to the landlord of the new property if the first occupant of the property is a tenant, and the landlords who are purchasing new homes for rental and investment purposes cannot obtain the NRRP from the builder. Instead, the landlord must apply for the rebate after closing. The application of the NRRP rebate must be filed within 2 years after the house purchase closes. The amount of the rebate is calculated pretty much the same as
Yes,
the one
previously.
discussed.
36% for 350. Then there's a blended rate from 360 to 450,
450,
and anything
falls
over
off.
450 falls off the
Exactly.
table.
It's also important to note that the purchaser will have to repay the NRRP. They should sell their home within 1 year, so that would be required to be
Okay.
repaid.
So that stops people from putting in tenants and then selling the house later on. Thanks, Dan. That was great. I think you got valuable insight on the PSBs and the especially the rebates for house builders. That's really important. Thank you very much, and great.